Many people spend their lives saving and preparing for retirement. But once your working days are over, you shouldn't stop thinking about investing in the stock market. Stocks are generally better investments that have the potential to build substantial wealth. They produce higher returns than other investments. However, higher returns always mean more risks. The stock market is volatile. A stock price can rise or fall dramatically within a short period of time. In a recession or market correction, for example, you can see your retirement investment portfolio loses half of its value. It can be a hard pill to swallow to see all of the money you have been investing for so long loses so much value, especially if you have been relying on it to support your retirement income. So, the question is, should you as a retiree, or soon-to-be retiree, stay out of the stock market entirely? Before I go any further, please take a moment to give this video a thumbs up, share it, and subscribe to the channel. It's free to do so, and it really helps the channel grow. Though stocks are generally thought of as risky investments, we believe that retirees should still invest in the stock market. That said, however, you generally want to be more conservative as you get older. So, if you don't get out of the stock market completely, what should you do? There are a few things you can do. The number one best thing you can do is to diversify your investment portfolio. You've probably heard the popular saying, "Don't put all of your eggs in one basket." A well-diversified retirement portfolio will help you minimize risks. If a stock of a company is not doing well, a stock from another company can balance it out. Thus, your risk is spread. There are different diversification strategies to implement. First, if you're dealing with individual stocks, it is better to own multiple and established stocks as opposed to a few. There are two kinds of stocks that are conservative: defensive stocks and dividend stocks. First, defensive stocks are stocks that give investors exposure to companies that offer services and products that are seen as essential. These companies are utility companies, telecommunications, consumer staples, and healthcare. Dividend stocks are stocks that pay shareholders profits monthly or quarterly or yearly. So, besides the fact that the value of your stocks can be increased through capital gains, you also make money through dividends. Another way to diversify your retirement portfolio is to consider adding mutual funds. Mutual funds invest in stocks or bonds from dozens of companies across multiple industries. Their diversification makes them a safer investment. So, if one stock is not doing well, another stock can balance it out. Investing in bond funds is another way to spread your risk. Bond funds can be useful if you're already retired and want income and don't want investments that fluctuate in value such as stocks. However, they are not going to give you particularly high returns. Though, they offer stability and the prospect of some growth. Bond funds that invest in municipal bonds are a good choice. They offer investors tax-free interest. They can also help keep investors from being pushed into the next highest tax bracket, which is something that pensions and required minimum distributions from IRAs and 401(k)s can do. Another reason to stay in the stock market after retirement is that you may have opportunities to accumulate more wealth during a bear market. That wealth can be passed down to your children. A bear market sometimes is an excellent time to buy stocks as they are often available at a discount. This is not to suggest that you should spend money that you don't have, nor should you necessarily rebalance your portfolio towards stocks only. There is always the risk that after you have bought shares in a bear market, they can decline even more. The bottom line is that while the stock market can be a risky place to be after retirement, it doesn't mean you should stay out of it completely. The best thing to do is to rebalance your portfolio, making it more conservative. Hence, spreading your risk. That's it for today's video. And if you enjoyed it and thought it was worth your time, please like it and subscribe to the channel. Doing so will help the algorithm, and I will be able to make similar contents.